Hi, everybody. Thank you so much for joining me. Before we get started, please hit subscribe to follow all of my latest investing and personal finance content. And be sure to check the link on your screen for a special message from our sponsor, The Motley Fool, where you can find the 10 best stocks to buy now.
So Walker and Dunlop has been one of my favorite stocks for a while. It's a small cap. They are a commercial real estate financing company. And over the past, say, 10 years or so, they've done a great job of growing their market share, becoming a real leader in the multifamily finance space. But this is still a very fragmented industry. They have a less than 8% market share. Um, but then again, they've done all this in essentially a 10-year bull run when the market's been very, very strong and things are doing well. They built up their servicing portfolio. They've established real estate investment banking. They've done a great job of building out their property sales division, like a brokerage division. But 2022 was kind of rough for them, and 2023 is not looking much better. Multifamily loan originations didn't drop off too much in 2022, but they are expected to decline by about 20% in 2023. So not only that, Walker, and I'm sorry if I'm stealing all of Tyler's talking points here, but Walker and Dunlop's market share actually declined in 2022 as fewer government-backed loans, because they're a big FHA and like a Fannie Freddie HUD lender in multifamily. But the stock is like roughly half of what it was at the peak. So I recently bought some more, and I have a feeling Tyler's about to tell me why that was a bad idea.
Well, this is where it gets weird, is because I've just had this itch I can't scratch with it, and I can't figure it out, and I don't know if it's a big deal, if it's nothing, or whatever. But as you said, they've been building out a lot of other services to complement its portfolio, right? Huge, kind of, they've been an acquisition roll-up for what they do. And as a result of that, there's been, when you make acquisitions, you tend to have to pay a little bit extra, and it rolls up into intangibles, goodwill, and a lot of other things like that. And we have is a company with total assets right now of $4 billion, and 2.1 billion of that is just goodwill and intangibles. And so I really am wondering, and I'm curious as whether or not all of those acquisitions that were made to, boost net profits, and like I know they use a lot of like adjusted core net income and adjusted EBITDA and things like that, and those numbers look great. But I start looking at things like tangible book value per share, and it's been cut in half since 2020. And so I start looking at things like that, and I go, what's going on here? I can't quite figure it out. That doesn't look right.
So how much of you mentioned acquisitions, so I have a follow-up with that. How much of their growth of the past 10 years, like I mentioned, was due to just them acquiring and acquiring and acquiring these companies and adding goodwill to their balance sheet? And how much of it was actually organic, do you think? Like roughly, do you think it was more of an acquisition story?
I'm going to use goodwill and intangibles as a proxy here. Total in 2020 or 2013, was 400 million for a 1.1 billion dollar company, and now it has 2.1 billion for a $4 billion in assets. And so to me, that's a significant run up in goodwill and intangibles, which probably means there was a lot of money spent on acquisitions.
So I added a little bit more to my position recently. It's still a relatively small part of my portfolio, but I do see a lot of potential on the other side, and it all depends on how quickly the market turns around, right? If the multifamily market breaks out in 2024 and beyond, it could be all good news for this company. But if things stay depressed for a while, they made a bunch of acquisitions in the past year or two, all at a premium, and it could really start to eat into their business. And like you said, the value of their assets can decline very quickly. So I don't know. Let's wait and see.
Yeah, it's the thing that I can't quite put my finger on, because, like, again, It's a lot riding on, is this just a levered bet on the momentum of housing and refinancing, which, they a lot of management projections claim that over the next 3 years, we're going to see significant refinancings and new originations, which I can also see, but how many of those refinancings are going to go two ways? There's some that are probably going to go delinquent, and there's probably some that are going to cash out because they've been hoarding cash. And so, maybe those numbers of like 300 and something odd $1 billion in refinancings, maybe if we want to be super conservative, 70% of those are actually going to come true. So you start putting numbers like that together, and I start to go, it really makes me think.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.